Hello and a very warm welcome to Econoday Unplugged on Thursday, 23rd of March 2023. Terry Sheehan's on the US East Coast, Max Arto's in British Columbia, Brian Jackson's in Sydney, and I'm Jeremy Hawkins in London. The recent turmoil in the global banking sector has added a new level of uncertainty to the economic outlook and significantly complicated the task of many central banks. Multiple failures in the US and the enforced takeover of Switzerland's Credit Suisse by UBS has set contagion nerves jangling, prompting downgrades to growth forecasts and, in some instances, triggering a marked reappraisal of where official interest rates might be headed. However, with the European Central Bank opting to hike benchmark rates by 50 basis points last week, the Federal Reserve by 25 basis points yesterday, and the Swiss National Bank and the Bank of England by 50 basis points and 25 basis points respectively earlier today, policymakers would still seem to be more focused on getting inflation back under control. Nonetheless, efforts to stabilise financial markets have meant renewed central bank intervention. So for now, quantitative tightening will have to run alongside fresh injections of liquidity needed to reassure investors that another global financial crisis is not just around the corner. So in today's podcast, we'll have a look at just how important the fallout from all this might be to economies and policies around the globe. So Terry, let's kick off with you. This banking crisis was triggered your side of the pond by, initially at least, the collapse of Silicon Valley Bank, and that certainly prompted record borrowing at the Fed's discount window last week. Do you think the authorities have done enough so far to calm investors' nerves, or are they just papering over the cracks?
I think they've done a pretty good job of reassuring the banking system that there will be ample liquidity for them. And so far, it seems like the thing that's worrying a lot of investors out there right now is there a systemic problem in the U.S. banking system? We'll probably hear more about that next week when Vice Chair of Supervision Michael Barr is going to appear before the House Financial Services Committee on Wednesday. So we can expect him to get quite a grilling.
Okay, I mean, I'll ask you about the FOMC in a minute, but just to obviously mention, we saw rates go up yesterday, and I guess it sounded like they might want to put rates up again. Do you think the banking sector can stand another interest rate hike?
Well, I think the outlook is probably for another 25 basis points and then pause. So yes, I think they can. I think a lot of banks have been put on notice that they need to take a careful look at how they're managing their capital and their risks. And I think a lot of behind the scenes action has probably addressed some of the problems right now. So yeah, I think the another 25 basis points, but probably not much more.
Okay, let me ask about Mr. Powell yesterday. One of the comments I saw him make, which I thought sounded quite interesting, was that you could effectively view the banking sector strain as a rate hike. So does that mean then that because of what's happening now, we shouldn't be expecting interest rates to go up as high as they previously did?
Good question. I think we probably can. I think what we're seeing right now is a little short-term volatility, and once things settle down again, the rates will be a little bit higher.
Okay, so you say short-term volatility because I mean, looking at these dot plots from the FOMC, if I've got it right, they're effectively expecting Fed funds or interest rates at the end of this year to be pretty well where they expect them to be in December, the December
Yes.
FOMC minutes. But we've still got markets believing that rates going to be, the best part of 100 basis points lower. So now, who do you think's right now? As a result of this banking issue, do you think it's more likely that markets will be right, or do you think that the Fed basically is going to get through this and its current view is more probably going to be correct?
I think we just went through this a couple of months ago with markets anticipating smaller hikes or signal for rate reductions sometime this year. And so far as the Fed's forecast is concerned, I think we're not looking for any rate cuts this year. And I think that the financial markets are getting ahead of themselves.
Okay, with regards to that, then what's the latest on the US economy? So you're not looking for any rate cuts, so presumably that either means the economy is doing pretty well or you're not confident about inflation coming down fast enough.
I think it's more the latter. I think from Powell's comments yesterday that they're just not seeing enough evidence that inflation is coming down as quickly as they might hope. So we can look for maybe not much higher rates, but for a restrictive policy to maintain for a while. The US economy, at least in the data available so far for the first quarter, actually has looked pretty good. But now with this disruption in the banking sector, it may have a slightly different outcome for the March data than we expected. Now we're seeing stronger housing market data than we were expecting because of the dip in mortgage interest rates. So that's kind of a plus. The labor market remains very, very strong. We may not be adding tons of jobs. We're not losing jobs so far. And we are seeing in the surveys of manufacturing and services for March that there does appear to be slowing in activity, but it doesn't look like it's accelerating from what we saw in February. So I think the first quarter is looking to be what Powell and others refer to as subpar growth, but and it may actually be a little bit of a negative, which it often is in the first quarter. But the underlying trend seems to be pretty good right now. Consumers are still spending. They are getting relief in some aspects of inflation that affect households. So for the moment, at least, we are getting through.
Okay, now I'm just going to I noticed at least some investment houses anyway have downgraded their growth forecast for this year. And that largely seems to be on the assumption that because of the problems in the banking sector, are looking for a cut in lending, particularly from the small and medium-sized banks. Do you think that will have a significant impact in the economy this year, or do you think perhaps they're getting a bit carried away with the downgrades?
I think they're maybe getting a bit carried away, but I do think that it's kind of interesting that back when Powell was giving a semi-annual monetary policy testimony, there was a lot of concern about overregulation of the smaller and regional banks, and now it's looking like they've been kind of underregulated. So it is going to be an adjustment for the banking sector. They are going to be looking very carefully at over-reliance on single sectors, or that where regulators have been seeing problems, there's going to be, I think, more effort to address them quickly.
Okay, fair enough. And the last one from me I was going to ask you, and we've seen the bond markets rally ever since these banking issues started breaking. Do you think we're at a stage now whereby, as far as the Federal Reserve's concerned, longer dated borrowing costs are too low, given the state of the economy and inflation?
I think they would like to see a little bit higher rates there, but I think they also have to allow them to work. They have to allow underlying conditions to work their way through.
Yeah, fair point. I must say, for all these central banks, given the amount of tightening they've done so far, as we all know, long and variable lags before we get the full effect. Yeah. Okay, well, that was my last question. Anything else you'd like to put into the pot, Terry, before I move on?
No, I think that's about it.
Okay, great. Thanks for that. Okay, Max, Canada. I guess Bank of Canada had already eased its, paused its tightening process earlier on this month. Is there any real fallout for the Canadian banking sector and indeed for BOC policy from the turmoil we have in the banking sector at the moment?
I don't see any signs at the moment, Jeremy, particularly because Canada's major banks have been strictly regulated, and then also they have this long-held business model of charging a fee for every transaction. And I don't know if you've lived here before, but not much choice among the six big, 5, 6 banks. And just like we don't have much choice in mobile phone plans. So their financial health is pretty good. And so I don't see any major impact on the profitability in the banking sector here.
Okay, fair enough. Right, let's go on to the economy then. As mentioned, BOC on hold at least for the time being, and you had some surprisingly soft inflation data in February. Obviously, depending what happens in the States and so on. But what do you think is the outlook now for the Canadian economy, and indeed what the Bank of Canada might be doing this year?
I think the pace of slowdown is as the Bank of Canada expected, and they're happy about it. I think if you look at the charts of the CPI and the core CPI measures, we're just back to where we started about a year ago. So they still have a little bit room to go down further. And I think the best position for the Bank of Canada right now is to keep in the conditional pause stance, and with a slight bias towards potential tightening, but there's no talk of rate cuts, as Terry mentioned, for the Fed. I don't see any need for this year anyway.
All right, steady as she goes in Canada. Let's just move across to Japan. I would guess that there's a fairly stable deposit base for domestic banks in Japan, so investors won't be too worried about the banking situation at the moment. Is that a fair comment?
We're going to see the Bank of Japan's latest view on that in April for the twice annual financial system review. And but at this moment, the three major banking groups, even though they have system problems and maybe still suffering from the negative interest rate, overnight rates, so profit margins low, but they're basically leaving a chunk of money, cash at the central bank, and so the deposits are safe over there, and they're still buying government bonds, although unrealized losses are rising a bit. The main concern has been on the regional banks. It's like a triple whammy of a falling population in rural areas, very low profit margins for all the banks because of Bank of Japan's super low interest rate continuing for almost 10 years. And then the latest is still remaining effects to the shutdown during the pandemic. So both the government and the BOJ have been asking regional banks to try to merge, and Bank of Japan has been giving bonus interest on deposits to the regional banks in exchange for plans to merge and also cut back on their costs.
Interesting. Okay, you mentioned, say, the older yield curve control, at least for the very low interest rates we've had for such a long time now. There's been some changes at the Bank of Japan, clearly with a new governor. But I understand was it so-called Mr. Yield Curve Control himself being appointed as the executive director in charge of monetary policy? So is this going to be implications for when we might finally see a shift in the yield curve control structure?
I know the expectation has been high that the new board is at least going to consider changing the yield curve control details, or even abolishing the unpopular negative interest rate on the short end. But now that we're seeing financial failures in other countries, I think they're going to start the new regime fairly carefully, And as you can see in the government's monthly economic report, the government has been saying they expect the Bank of Japan to continue providing monetary support. So I don't think there's going to be a drastic change, but it is. It would be more natural to let the longer end yield rise a little bit along the expectations for our economic recovery, and that would be a more natural course of action. But it's going to be a careful process, I think, and without announcing the start of a review or even producing serious review, I don't think they're just going to announce that they're going to change the whole framework.
Okay. And I guess, part and parcel of what they are going to do is obviously down to inflation. Now, we saw a sharp decline or deceleration, I should say, in the Tokyo rate for February. How much of that was due to sort of underlying factors, and how much was it just due to government subsidies and the like? I suppose, the big picture is what's actually happening to underlying inflation in Japan now?
It's basically the effect of the government's expanded subsidies for both business and consumer gas suppliers. So that's basically it. But at the same time, still there's an upward pressures from food suppliers, durable goods, because of still high import costs. And that, in economics term, is just cost push inflation, not demand pull. So it's not really what the government and BOJ want to see. And having said so, on slightly brighter side, companies are scrambling to offer at least temporarily, benefits and wage hikes, because they don't want to lose people, and that's because of the serious inflation. But if you look at the core of the core inflation, I think it's about 3% now. But again, if you look at the base effect of last year's spike in commodities and energy costs, that would gradually come off towards the end of the fiscal year starting this April.
All right. Okay, that's fair enough. Anything else you want to add?
Nothing so far.
Okay, great. Many thanks for that, Max. Right then, let's go to Sydney. Bran, China. What do we got? Well, first cut of the year in bank reserve ratio. Was it last week, wasn't it? Why?
Well, I think they're still, relatively weak in terms of, this rebound that we are seeing from last year, where the weakness was very much driven by the public health restrictions.
Mm-hmm.
As we know, they've lifted those towards the end of last year, and we are seeing a bit of a response in the data that we've had to date so far this year. But it's still a pretty subdued economy, and I guess they just wanted to give it a little bit of a nudge, and also perhaps in response to concerns about broader financial stability around the world. I think the bottom line, though, is that they're reasonably confident that we will see those numbers start continue to improve in coming months, given that public health conditions have improved.
Okay, can I ask about inflation as well? Because we saw, was it a very low number for February? If I remember right, was it 1% headline number for the CPI, which was well below what the market was expecting? Is that just some kind of wobble due to the way the data are constructed and Lunar New Year and this sort of thing? Or is it the fact that growth has slowed so much now that the inflationary pressures, which haven't been that strong, let's be honest, in the first place, but they seem to be dissipating?
I think you've got to really pay a lot of attention just to the timing of Lunar New Year holidays. I mean, if you look at January was up from December. It was 2.1%, and then you did have that step down in February, and that's quite a common thing to happen in the first couple of months. A bit of volatility between the January and February numbers, just because of all the base effects that get messed up by the timing of the Lunar New Year holidays. So it's probably better to take an average or some sort of combination of those 2 months, and then when you do that, it's not too far from where we were towards the end of 2022. and I don't think a real indication that we will see a big shift in where inflation is heading.
Okay, and I've got to ask you, is there any kind of fallout in China from the banking crisis?
I haven't heard a lot of discussion or seen a lot of people talking about it. They can often be relatively insulated from these things. Obviously it's a very different banking system in China, and a lot of government control over what is happening there. So there's plenty of problems in the Chinese banking system, but the contagion from this specific event I don't think is a huge focus at the moment.
Okay, and I guess we move across more to your part of the world in terms of Australia and presumably New Zealand as well. Fallout there seems to be relatively limited. I saw a comment, if I can find it, from the I think the RBNZ chief economist, basically saying that they're not worried about having to access the old swap lines from the Fed, so liquidity doesn't seem to be an issue there. And that's sort of typical of the region.
Yeah, and I mean, I've been trying to find some comments actually from the RBA, their response to it. I haven't really found it. So I don't think they're too concerned about it. We have had the Australian Treasurer come out and just basically say, yeah, we're good, don't worry about it, everything's under control. Just sort of reassuring domestic markets. And again, it doesn't seem to be a huge focus for officials at the moment.
Okay, but so we stick with Australia then. It does seem that from what the RBA, well, it was, where are we? Beginning of the month, wasn't it? When it came out and did the latest increase in interest rates, which didn't surprise anyone. Was it fair to say that they've kind of tempered some of their hawkish guidance on policy now?
They have, definitely. Not only in the statement, they basically acknowledged, the impact of previous policy tightening, and just recognizing that they've already done quite a bit, and so that might mean that we're coming to the end. But they actually went into a little bit more, or a little bit more explicit in the minutes, which came out a few days ago, just saying, look, we actually will put on the table at the next meeting, considering a pause in rate hikes. Whether that happens in April or May, people are starting to think, okay, they are close to, pausing, or and then perhaps holding for a while. What they said in the minutes was, in particular, they'll be looking at three numbers: the employment number, retail sales, and the monthly inflation number. So we've already had the employment number that was out last week, and that was actually pretty strong. So that could obviously way towards going again next month. So we'll see what happens with the retail sales and the inflation, the new monthly inflation number, which will come out in the days leading up to that April meeting. So if that shows a bit of weakness in retail sales, a bit more of a drop in the monthly inflation number, then I still think, on balance, you'd probably expect at least another hike in April, but they're obviously starting to think about pausing at some stage.
Right, and is that the same sort of applies to the RBNZ?
Yeah, I think they're still leaning towards some more, but also conscious, as the RBA is, that of the fact that they've done quite a bit. The other thing that is going to be muddying the water in New Zealand, though, is just the impact of these cyclones that we had back in February.
Right.
They noted when they raised policy rates in the immediate aftermath of that's going to impact. It's probably going to reduce activity in the short term, boost price pressures in the short term, and that they want to look through that short term impact. But how they actually balance those factors with the longer term issues is going to be interesting, and no doubt that will be a talking point at the next RBNZ meeting. We are already starting to see the impact of that in the data. We had some trade data out again earlier in the week, showing a big drop in trade flows in February, and that was largely just because of the damage to infrastructure, and particularly around one of the major ports in New Zealand. Just physically meant that trade flows were lower than what they would have been, and I think that's just going to be a common a message in our reports on New Zealand data in the next few months, just the impact of that cyclone damage in February, and so that will put a little bit of volatility, and just means we have to think a little bit harder about how that might feed into RBNZ policy.
Yeah, as they're trying to work out what the underlying picture is. Okay, right. Anything else from your part of the world, Brian?
Just it's interesting that we are, I think, seeing a bit of a divergence in some of the central banks here. We had Taiwan yesterday. It raised rates 12.5 basis points.
Because
well, just it's still obviously dealing with inflation pressures, and a few people did think that they might have held, but they went ahead. But then we've also had the BOK, sort of bank in South Korea. They're sort of starting to think about they didn't hike last time, and they're thinking about some of the different impacts. One of the things that was interesting, we did have a sort of a report come out from the Bank of Korea, a bit of a study about what the impact of a recovery in the Chinese economy will have on their economy, and it could be a bit of a template for how a Chinese recovery will impact more broadly countries in the region. Their assessment, the economists at the Bank of Korea, is that the recovery in China is mainly going to be driven by domestic consumption rather than an increase in export demand. Just noting, there's been such a build-up in inventories, you might not see Chinese demand actually in the very near term benefiting regional exporters. It might be mainly a domestic-led recovery. So that's quite interesting, and that we can see going forward whether there is much of an impact on external demand for some of these major Asian countries.
Okay, great. Thanks for that, Brian. Right, let's round off with Europe. Well, I guess banking worries may not have stopped the central banks tightening today, or indeed last week, but they've certainly trimmed some of the expected peaks to money market rates, typically, I guess, between about 30 and 50 basis points. And indeed, it's worthwhile pointing out, at least as far as Europe's concerned anyway, that banking stocks lost further ground today. They're down about 2.5% or so. So they're still above the lows we saw after the SVB announcement, but even so, banking sector as a whole in Europe still looks to be extremely shaky. Nonetheless, we mentioned in the intro, the Swiss National Bank earlier today rose by their policy rate by another 50 basis points to 1.5%. And very much the clear message in that was that, one, don't worry about the Swiss banking sector. It's perfectly stable at the moment. And two, they're not happy with the recent rise in inflation, which has certainly caught some people by surprise, which means that they're still very much looking to tighten policy until such time as they get inflation sustainably back down below 2%. And on that front, it's worth noting that the updated economic forecast the Swiss National Bank came out with shows inflation actually above 2% throughout their 3-year forecast horizon. So I guess implicit within that is that policy is still too loose. So at this stage, clearly banking sector issues notwithstanding, it looks as if we could well see perhaps 25 basis points at their next meeting. Where are we? At the back end of June time. Nonetheless, looking at the banking sector in Switzerland, obviously we had the Credit Suisse takeover by UBS. Bottom line to that, I suppose, is that it's still a case of too big to fail. Certainly applies. Credit Suisse, assets of about 530 billion Swiss francs on its balance sheet at the end of 2022. So that is more than double what Silicon Valley banks had. So it does underline how important it was as a global banking player. And also, of course, it's one of the 24 or so primary dealers with the Federal Reserve. So the big picture is still a case that when you get a really big bank, they're not prepared to let it go under. What else can I say about Europe? Well, as far as the ECB's mentioned in the intro last week, they hiked by 50 basis points, which is an interesting decision because clearly that came shortly after the American banking wobbles, and there was a lot of suspicion that they might decide to do perhaps only 25 basis points or even not do anything at all. They had, of course, pre-announced at the February meeting that they wanted to do 50 points. And in many ways, I think they kind of sort of got themselves into a corner whereby, as some members apparently actually admitted, that they were worried that had they not done a whole 50 basis points, then it would have been interpreted by markets as a possible indication that there are banking problems at home, and they certainly didn't want to do that. Nonetheless, some of the comments we had coming out just before the ECB meeting from some of the governing council members intimated that, well, look, we shouldn't be doing more than 25 basis points. So the fact that they actually did 50 suggests there are still some fairly large splits taking place on the ECB at the moment. Market reaction, well, it's certainly been helped to, the banking situation has certainly helped to trim expectations of just how high rates will go. We're looking at 3-month money, that the peak for this year prior to the Silicon Valley Bank problems was at 4.1%. That's now been trimmed down to just 3.5%. So effectively, they're talking at most, what, another 50 basis points on ECB interest rates. Bottom line, I think, from most of the comments coming out still suggests that they're not happy with where inflation's going at the moment. Of course, they had a really bad set of inflation numbers for February. And the chief economist, Philip Lane, I think it was yesterday, was saying effectively, well, if a baseline forecast holds up, then to quote, there's absolutely more to do. So again, it's still got obviously one eye on banking sector, but our fundamentals suggest, as far as they're concerned, at least inflation numbers anyway, is that interest rates have to go up further again. As far as the Bank of England concerned today, they fulfilled market expectations, putting rates up by 25 basis points. So that puts our benchmark rate, the bank rate, at 4.25%. As expected. The vote was 7-2, and I must say, originally at the beginning of this week, I thought it could be a lot closer than that, with more people going for no change. The two voters here of two main doves, again calling for no change in interest rates. But effectively, I think they were boxed in after a big surprise jump in the CPI for February announced earlier on this week. The bank admitted it was 0.6 percentage points above the bank's own call, went up to some 10.4%, the annual inflation rate, which is well above both the bank's call and also what markets were expecting as well. Prior to that, even the governor himself, Andrew Bailey, was kind of hinting that perhaps rates didn't actually need to go up again. Looking through what the communique, the minutes said from the meeting, I guess we're getting to a stage now whereby rates might have topped out, but if that's going to be the case, then we're going to have to see much better behave both price and wages data. Otherwise, we could well see another 25 basis points at the May MPC. Fallout from all these banking community issues. Well, the bank did its best to dismiss it in a sense that its own financial policy committee came out and said that the UK banking system's robust and it's got strong capital and liquidity positions like most other central banks are saying at the moment. Indeed, they maintain it's well placed to support the economy in a whole wide range of economic scenarios, including in a period of higher interest rates such as we have so far. So probably it had little impact at the end of the day on the rate decision, but clearly if things do deteriorate further, that could very much quickly change. What else I'll be mentioning? Well, as far as the UK is concerned, the economy, at least the economic view coming out the Bank of England, is certainly getting increasingly better. They've revised away their expected 0.4% contraction in real GDP in the first quarter. They're now kind of expecting it to be pretty well flat. No recession expected this year. So over the course of the last 3 months or so, the bank's view on where the economy is heading has changed quite significantly. And certainly, although it's still going to be one of the weaker economies in Europe and indeed amongst the G7 as far as 2023 is concerned, it is looking significantly brighter than it was not very long ago. But I guess, pulling it all together, the bottom line as far as Europe's concerned is that most central banks are pretty well still in tightening mode. They're downplaying the effects of the potential fallout from the banking sector wobbles, but they've still very much got a wary eye on them. And indeed, I guess that's reflected, just going back to the Bank of England, where they were quick to address the issue of the Silicon Valley Bank when it came out and arranged the purchase of the UK arm by HSBC Bank within about 24 hours or so of the announcement from SVB coming out on the Friday. So they certainly look to address that very quickly. And there's certainly suspicion still that there could be some banks with problems. OK, well, I guess then that is probably about it for today. Takeaways, well, I suppose lessons learnt from the global financial crisis in 2008 should mean that global banking sector is now much better equipped to deal with unexpected surprises. But as we saw a couple of weeks ago, when confidence is lost, capital moves very fast and contagion effects can be very hard to contain. In fact, according to the new Bank of America survey taken between March the 10th and the 16th, global fund managers saw financial market stability risks at their highest level since last November. And that was due to the largest monthly increase since March 2022. The shift, people recall, was just after Russia invaded Ukraine. So far, the official response seems to have broadly worked, but it's early days yet, and investor nerves are not going to dissipate overnight. So for now, at least, economic and policy outlook must remain very clouded. So then it's just as well that all the key market moving data and events can be found and clearly analysed in Econoday's global economic calendar. Do take a look. And on behalf of Terry, Brian, Max and me, thanks as always for listening. We hope to see you again next time. Bye for now.